Hello and welcome back to the Geordie Pig Investor channel, where we look at portfolios so you don't have to panic alone. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. Alright, let's be honest, this video was either going to inspire you or make you feel way better about your own portfolio. Either way, you're welcome. We're breaking down a subscriber's holdings, their investment strategy, and probably his spirit. No, but seriously though, let's dive straight into it. Today's portfolio is from a subscriber called Martin. He is a fellow UK investor and is 55 years old. Once I've reviewed every stock, I'm going to give my overall thoughts on the portfolio and if I would change anything about it. But first, let's look at his investing background. Martin has been investing into a workplace pension all his life alongside owning a SIP. For years, the SIP just sat there and he didn't do anything actively with it until one day he watched a video on dividends and compounding returns. After watching this video, he moved his SIP into a free trade account in May 2024, which was worth around £40,000 at the time, and he has been adding to it ever since. He is now mainly looking for solid dividend paying companies and mixed in with some ETFs and a couple of higher risk AI stocks. He wants to have a portfolio of no more than 15 total stocks and ETFs and retire in 5 years time once he reaches 60. The aim is to then live off the portfolio alongside his workplace pension. So let's start off by having a look at his overall portfolio value as of right now. It sits at just over £90,000, so it's grown a substantial amount since it was converted into free trade back in May last year. You can see already that the portfolio was up over £7,500 from when he switched it across into free trade, and his portfolio currently consists of 16 stocks and ETFs, which is already a big tick in my books, as I've mentioned in the past how I believe if you have more than 30 stocks in your portfolio, it becomes extremely hard to manage and keep track of each of them, so 16 is a very manageable number. Anyways, that's enough rambling on. Let's actually see all the different holdings within Martin's portfolio and see if it aligns with his investment objectives and if there are any areas he could improve moving forward. The first stock that he owns in his portfolio is a UK tobacco giant known as a British American Tobacco. This is his biggest holding at just under 10% of the portfolio and is also one of the best performers, with the position currently up around 37%. British American Tobacco is one of the world's largest tobacco companies, known for manufacturing and selling cigarettes and next generation nicotine products. It was founded in 1902 and headquarters in London. BATS owns global cigarette brands, but in recent years has been shifting focus towards reduced risk, non-combustible products such as e-cigarettes, heated tobacco and oral nicotine pouches. The company operates in over 180 countries and generates the bulk of its revenue from traditional tobacco products, while aggressively expanding its smoke-free portfolio to adapt to changing consumer trends and regulatory pressures. They have a very high dividend yield that sits at over 6% and have grown their dividend for 8 years in a row. They don't have a great 5-year growth rate, but remember that Martin isn't going to be so fussed by this with his investing goals. I think British American Tobacco is a solid choice for someone retiring in 5 years and planning to use the dividends for income, because it offers a high, reliable dividend yield that's supported by strong free cash flows from its global tobacco business. The company has a long history of consistent dividend payments and is transitioning towards lower risk nicotine products, which could help sustain future earnings. Its defensive industry, predictable revenue and relatively low valuation make it appealing for income-focused investors like Martin, who seeking stability and strong yield leading into retirement. Next up in the portfolio is PHNX Group, stock ticker PHNX. Martin has a position size worth over £8,000, which is just under 9% of the portfolio. The position is currently up 13% and it has a massive 8% yield on offer, so I'm sure he is up even more when including the dividend payments received. PHNX Group Holdings plc is the UK's largest long-term savings and retirement business, serving around 12 million customers and managing approximately 290 billion in assets. The company operates two main segments: a heritage runoff business that manages closed life and pension books, and an open business providing new pensions, savings, annuities and life insurance to active customers. It also leverages its scale and expertise in the UK market to generate strong operating cash flow, with a 1.4 billion in 2024, while maintaining a progressive and sustainable dividend policy aimed at creating long-term shareholder value. In my opinion, Phoenix Group is a strong choice for someone retiring in 5 years. With the company offering a high, sustainable dividend yield backed by predictable cash flows from its long-term insurance and pension businesses, I feel this is a great choice for Martin. It focuses on closed life insurance books providing steady, low-risk income, while its growing, open business adds future upside. With a solid capital position and a track record of dependable payouts, Phoenix is well positioned to deliver consistent income when needed most in retirement. The next stock in the portfolio is Rio Tinto, stock ticker RIO. This stock is one that's not performed great as it's currently down over 13% in the portfolio, but like all the others so far, they do pay a very attractive dividend yield and are also based within the UK. Rio Tinto is a multinational mining and metals company, and they operate in around 35 countries across the world with over 60,000 employees. They produce essential commodities including iron ore, copper, lithium, diamonds, titanium dioxide and other critical minerals that support global infrastructure, renewable energy development, manufacturing and decarbonisation efforts. Rio Tinto can be a good company to own for someone like Martin who's planning to use dividends as income, but with some important caveats. The company offers attractive dividend yields, often in the 5 to 8% range, supported by strong cash flows from its iron ore and copper operations. However, its dividends are variable, tied to commodity prices which can fluctuate with global demand, especially from major markets like China. And while Rio's balance sheet is strong and it focuses on shareholder returns, the cyclical nature of mining means that income from dividends may not be as predictable year to year compared to more stable sectors, as this was highlighted recently with their dividend cut. So remember, this is a very volatile cyclical sector, and it's not a company that I'd be rushing to own if I was looking for more stable, predictable income, especially if I was close to retirement. The next stock is one I'm really happy to see. It's none other than the Vanguard S&P 500 ETF, stock ticker VUSA. This ETF takes up just over 7% of the portfolio, and he is up over 5% on the position currently. I do think that having a core holding in the portfolio as an ETF is very important, and he could look to increase the size of this one. The S&P 500 is a stock market index that tracks the performance of the 500 largest publicly traded companies in the United States. Over the long term, the S&P 500 has averaged anywhere from 8 to 10% annualized returns, hence why it's actually the biggest individual position in my own personal portfolio. I know that Martin has a shorter time horizon, but my advice would still be to invest into this fund over the next 5 years before eventually looking to sell it to reallocate the capital into a lower growth, higher dividend paying ETF such as JEQP. This way he can maximize the growth side of it before swapping it out for a frequent dividend monthly paying steady income ETF. Next up in the portfolio is Imperial Brands, stock ticker IMB. This one is just under 8% of the portfolio and has saw a fantastic 51% return. Similarly to BATS, Imperial Brands is a major British tobacco company and is actually the world's 4th largest international cigarette maker. In addition to traditional tobacco, it is expanding into reduced risk products such as blue e-cigarettes and ID heated tobacco systems. They are sold in more than 120 countries across the world and have over 25,000 employees with annual revenues approximately 32 billion. Imperial Brands combines high-margin combustible products with growth in next-generation nicotine offerings. Imperial Brands can be a good company to own for someone retiring in 5 years and seeking dividend income, mainly due to its high, stable dividend yield. They do have strong cash generation from its global tobacco business, and the company focuses on maintaining shareholder returns with the consistent dividend payouts, but like other tobacco stocks, it faces long-term regulatory and consumer decline risks, and growth is limited. This is definitely something for Martin to consider, and he's also got to consider that he has nearly 18% of his entire portfolio in just the tobacco sector. He has already seen some really solid gains within these two positions, so I think he could look to take some profit off the table and reallocate the capital into different sectors for better diversification. Next up is Games Workshop, stock ticker GAW. Again, this one is just under 8% of the portfolio and has also saw a solid 12% gain thus far. Games Workshop is a British manufacturer and retailer of premium tabletop miniature war games. It was founded back in 1975 and designs, produces and sells plastic and metal model paints, hobby tools, rule books and related content. The company also monetizes its intellectual property via licensing deals for video games and media projects, making it a vertically integrated leader in niche hobby gaming. This company has a history of paying generous and growing dividends with a 5-year growth rate at over 17%, supported by strong margins, global brand loyalty, and a highly profitable niche in hobby gaming. Its vertically integrated model and valuable intellectual properties give it pricing power and resilience. However, its dividend yield is modest at just over 2% and earnings can be somewhat cyclical, tied to product release schemes and consumer spending trends. I think it's a solid pick for long-term dividend growth investors, but less ideal for someone needing high immediate income, so maybe one that Martin could look to sell out of in a few years. The next stock is TSMC ADR, which is just under 8% of the portfolio. This position is up close to 5% currently, and Taiwan Semiconductor Manufacturing Company is the world's largest dedicated semiconductor company. They manufacture advanced chips for top global tech clients like Apple, Nvidia, AMD, and Qualcomm. They power a wide range of products from smartphones and high-performance computing to AI and automotive applications. With over 50% of the global market share in semiconductor fabrication, the company plays a vital role in enabling today's data-driven and AI-powered tech ecosystems. For me, although I do really like this company, I'm not sure it's an ideal choice for Martin. The dividend yield is relatively lower, under 1.5%, and it's more focused on growth and income, especially since they cut their dividend 2 years ago. That said, it is a financially strong, globally dominant semiconductor company with high profit margins and growing relevance in AI and advanced tech. So for an investor willing to prioritize long-term capital growth, TSMC could be a valuable part of a broader portfolio. I know Martin mentioned he did want to have some riskier plays in AI, and if this is one of them, then fair play. I don't really see anything too wrong with the company. He just obviously needs to consider the fact that he won't be getting massive dividend payments from them. We then have another ETF in the portfolio, which is the FTSE All-World, stock ticker FWRG. It's another position that's up close to 5% and takes up just under 8% of the portfolio. The Invesco FTSE All-World ETF is a low-cost, physically replicating index fund that tracks the FTSE All-World Index, which covers approximately 4,000 large and mid-cap stocks across both developed and emerging markets worldwide. Again, I love to see solid ETFs within the portfolio, and this one gives him great global exposure. I think that the FTSE All-World ETF is a strong choice for someone retiring in 5 years who wants a globally diversified, lower risk investment to generate dividend income over the long term. While its dividend yield is modest, as it usually sits around 1.5 to 2%, it offers exposure to thousands of companies across developed and emerging markets, reducing reliance on any singular region or sector. The fund includes many dividend-paying blue-chip stocks and tends to grow steadily with the global economy. Though it may not provide high immediate income, FWRG is well suited for a balanced retirement portfolio that combines growth potential with stable, long-term dividend income, and I feel this is a much safer choice with the global exposure compared to singular stock picks with a dividend yield in the similar region. And the next stock in Martin's portfolio is Greencoat UK Wind, stock ticker UKW. The position is currently down around 11% and is just under 8% of his overall portfolio. Greencoat UK Wind is a UK listed investment trust that owns and operates a diversified portfolio of 49 onshore and offshore wind farms across the UK. Greencoat UK Wind is a really strong option for Martin because it has that very high 8% dividend yield and the goal of increasing payouts in line with RPI. The company generates steady, predictable cash flows from a diversified portfolio of UK wind farms under long-term contracts, making it well suited for income-focused investors like Martin. While it carries some risks tied to power prices, weather variability, and interest rates, its regulated revenue streams and inflation protection make it a reliable source of passive income heading into and during retirement. And finally, we will look at Legal & General, which takes up just under 7% of the portfolio and has seen a nice 12% increase since he bought the shares. Legal & General is a long-established UK financial services group. It combines pension risk transfer, life insurance, retirement income, and asset management across both retail and institutional clients. They manage over 1 trillion in assets across public and private markets. Like most of Martin's stocks, I feel that Legal & General is a strong candidate for someone retiring in 5 years and planning to use the dividends for income. They have a consistently high dividend yield and have been a reliable payer for many years within the UK, so for me, this is just another fantastic pick in Martin's portfolio. A couple of other standout stocks in his portfolio are National Grid, Chevron, and Diageo, but all do have slightly smaller allocations. And as he did mention at the start of the video, he wanted his portfolio to be 15 stocks, with it currently sitting at 16, so he may want to look to sell out of potentially one of those smaller positions in the portfolio. And what do I think overall? Well, I think that this portfolio is well constructed for someone retiring in 5 years, offering a strong blend of reliable dividend income, global diversification, and exposure to defensive, cash generative sectors like tobacco, insurance and pensions, infrastructure, and consumer staples. It's balanced with growth potential from high quality names like TSMC and Games Workshop, while the FTSE All-World ETF provides broad market exposure and risk mitigation. The portfolio features many stocks with yields in the 6 to 9% range, which is ideal for income generation in retirement. However, some risks remain, including sector concentration in tobacco and financials, sensitivity to interest rates, and variable dividends from cyclical stocks such as Rio Tinto. I feel Martin does have fantastic allocation with his stocks, with no one particular stock having an overweighting, and has a lovely balance between them, with most falling between the 5 to 9% range. But if you know me, you know that I always think you can have slightly more exposure to ETFs, so I'd be even more of a fan of the portfolio if he increased the 2 core ETFs to around 20 to 30% of the overall portfolio, then used the big UK dividend payers as his satellite stocks. And I might add how I think having UK dividend paying stocks as the majority of his stocks is a great idea with the tax benefits he receives from this, especially when needing the income. Overall, I think it's a well-diversified, income-focused portfolio with solid fundamentals. Just keep an eye on overexposure to specific sectors and ensure a balance between yield and dividend reliability. So I'm going to give Martin's portfolio a 9 out of 10. I think for his time horizon and goals, he has a really well worked out, solid, manageable portfolio. So hopefully he can see some more gains in the next 5 years and set himself up nicely for retirement. I've loved to re-review this portfolio again close to the time to see if he is on track to achieving his goal and if he actually ended up making any changes. What rating would you give Martin's portfolio? Do you think you could score better than Martin's portfolio? Why not feature in the next video by simply commenting your X handle, and then I can send you a message on X at the Geordie Pig. And that's a wrap on today's portfolio review. Hopefully you're feeling smarter, richer, or at least mildly entertained. If you enjoyed the video, please smash the like button like it owes you money and subscribe so you don't miss the next hot stock pick. Until next time, keep compounding and stay patient in the market, because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.